Good afternoon. Thanks for joining us. I'm Paula, Ebben. Wall Street kicking off the week with a bumpy start. The Dow dropped 600 points and stocks fell into bear market territory today. The Nasdaq and S&P also saw negative gains, causing some investors to worry about what lies ahead for the U.S. economy. The Federal Reserve raised rates by a half point last month and is expected to raise interest rates again later this week. We've been watching a very volatile day on Wall Street. Joining me now is financial advisor Mike Armstrong from the Armstrong Advisory Group. Mike, thanks for taking the time. So the Dow is down significantly. The S&P 500 is nearing a bear market. Where does this leave investors? What should people be thinking about today?
Yeah, never any sort of good news when you have investors and market commentary talking about a bear market, but that's what we're talking about right now is, after last week's 5% sell-off on the major indices, we're down several more percent today. And, investors are taking a look here and saying, look, this inflation that we were hoping would be transitory and might get under control showed on Friday that it really is not under control. It is not showing signs of improvement. And until it does, I think very clearly there is going to be some pressure on markets here while the Federal Reserve does its job to control inflation via the only tool that they have, which is a bit of a blunt force object for trying to control inflation like we're seeing today. But that's my read for the market sell-off at the end of last week and today is, look, inflation, in spite of the Federal Reserve's best efforts and the tough talk, is not being under control, and it's showing signs of worsening at this stage.
Right. And here's the problem. Younger people, of course, can hopefully weather this kind of financial hit to their 401k. You're always told,
Sure.
Just don't look, right? But what about older folks closer to retirement age?
Yeah, I mean, that's where it's really damaging. I mean, the New York Times had an article about this exact subject. Nobody wants to time the market, but if you're over the age of 72, the IRS is going to mandate that you take money out of your retirement account, and it's all going to be based on the value of that account when markets were at near all-time highs. And so, they're determining your required minimum distribution based on where the account was in January. And if it's all in stocks, then it could be down 20% from those highs. I guess my first message is not a terribly useful one, but, my hope would be that if you are in that stage of life, that you have thought forward about what your requirements are going to need to be from this portfolio and don't have those in equity markets in the first place. That's certainly my advice to people that I work with, which is, hey, if you're going to be taking money out of this portfolio, take a look at the next 5 years and how much you might need from that portfolio. And most of that probably shouldn't be invested in the stock market, because on a year-to-year or even a 5-year-to-5-year basis, the stock market is quite unpredictable. If you're taking a look at that today and saying, hey, well, I didn't do that, and now I'm behind the 8 ball, and perhaps I do need to look at equities that I have to sell in this situation because I have expenses that need to be paid or I have a required minimum distribution, that's a tremendously difficult position to be in. But I would also say that there's no guarantee that this immediately gets better, right? I mean, oftentimes we have seen scenarios where, 20% market sell-offs occur and then they improve. But other times, they have gotten worse before they've gotten better. And I think we should be prepared for that given the circumstances.
Sure. Inflation keeps getting worse, as you say. Fears about recession become more real by the day when Jamie Dimon is using the word hurricane. That certainly makes people nervous. So is there any hope on the horizon?
Well, I think the Federal Reserve is doing, everything in their power, and we'll be hearing from them. They're going into their meeting this Wednesday, so we'll be hearing from the Federal Reserve shortly in terms of the actions that they're taking. But I think what people have to understand is that the Federal Reserve does not have some magic wand to fix our economy when they're dealing with problems like that. I think if might be a fair criticism that the Federal Reserve is also behind the 8 ball when it comes to inflation. But if they are, what that's going to mean is that the only tool that they have is raising interest rates to weaken demand for all sorts of things, right? Demand for housing via mortgage rates, demand for cars via car loans, and all sorts of things. But where I think you might see some action over the coming months is what can be done when it comes to oil prices and prices at the pump. Obviously, there's been a lot of pressure on the Biden administration to address that issue, and so far not with a whole lot of success. But where might that relief come from in the coming months is definitely an important question at this stage, because that's driving a lot of the inflation that we're seeing right now.
Here's what I'm curious about for people in your field when you're watching. I mean, there's the Paul Volcker model that when the chairman of the Federal Reserve in 1981 had to really put the country into recession to recover, right? Inflation was so out of control. The hope was this time, by kind of tapping the brakes and raising interest rates just a tick, was going to hopefully slow down inflation. If that's not working, what kind of decisions do you see coming from the Federal Reserve? Are we suddenly going to see a big rate hike?
You know, I think there's certainly an argument for that, and people are now pricing in that possibility that, you know, Jerome Powell and the Fed had said there would be a 50 basis point increase, and could there now be a 75 basis points or even higher increase? I think the certain answer seems to be that, hey, the number of increases that are going to be required to get this thing under control might take longer and might need to go further than people had previously anticipated. The frustrating part is you would love to see. What the Federal Reserve does is they impact the demand for all these things that we're talking about. But as we know, prices are an impact of both supply and demand. And so you can weaken demand. You could also invest in supply. You could do things to invest in housing, for instance, to try and make rents more affordable. You could do things such as not a terribly popular thing to do given concerns about climate change, but drilling for oil and guaranteeing some of the processes that go into that. Obviously, those can be politically difficult decisions to make, which is why the Federal Reserve needs to act on their own to say, hey, even if it does end up causing a recession, we need to take action here because prices are really getting out of control at this stage.
Right. All right. Mike Armstrong of the Armstrong Advisory Group, thanks for your expertise. We appreciate you joining us.
Thank you.